To buy or not to buy? That is the question. So I get anywhere from 8 to 25 emails or messages per day or Skype message per day on and on asking, Mike, when is it a good time to buy? Well, this article here kind of supports all the English Commonwealth. So if you're in Canada, Australia, New Zealand, United States, UK, wherever you are, even South Africa, this is a really good, well-written article that kind of gives you a little bit of insight on how. So let's debunk this article a bit and kind of look at what they want you to see, or what they're telling you is going on, and what they want you to kind of fabricate and imagine in your mind. To buy or not to buy? The million-dollar housing question Australians keep asking. The answer depends on who you talk to. Some say the recent bounce is just a blip. That's the question. Others argue that the property market has turned the corner. Depending on who you speak to and who you read, the Australian housing market is rebounding after a period in doldrums, or still locked in a downward spiral. Guys, this is a dead cat bounce in my opinion. I've been following the Australian housing market for years now. Years. I'm talking about like 2014. Okay, so right now it's in a dead cat bounce. Right? There's too many inflated bubbles in pockets of Sydney, and there's quite a few overly inflated bubbles in Sydney. And if you go back to my channel and look at the video I did, is getting a lot of traction. Toronto real estate ripoff. And if you see what $2.6 or $2.8 million buys you in Toronto, you'll see exactly what I'm talking about. And then this one here is getting a lot of traction. Wake up, Australia. Anyways, so let's go back here. To buy or not to buy? That is the question. Some say Reserve Bank double rate cut in a few weeks after the federal election, plus loosened credit standards have been circular in the sweeping away the gloom. Remember, guys, they have to do this. They have to do this because first-time home buyers are not getting in the mix. Once you get the first-time blood out of the market, it's over. You need fresh blood. You need fresh blood for the market to continue flowing, right? With borrowing costs now lower than ever and the prospect of more rate cuts possibly as early as Tuesday, the way has become cleared for prices to start rising in the traditionally busy spring selling season after 18 months of decline from the market peak in 2017. So let's take a look at our 18 months decline here. Okay. Come on, show me a graph. Here it is. Here's your 18 months decline here. This is from Shane Oliver. So now they're expecting an increase now. So your blue, so this is Melbourne and that's Sydney. And what's red here? So there it is right there. Melbourne and Sydney, they're both in declines. And this is the capital city average ex Sydney and Melbourne. So there it is. Not looking good right now. I believe it's kind of almost like if you guys look at what's happening at Perth. If you weren't sleeping under a mountain for the last 2.5 years, 3 years, you'll know that Perth is on a 18 to 25 quarter drop. Why? Because anything that's during the mining boom in Perth in Western Australia, if you know anything about that, you would know that houses went pretty much double the price within a matter of months to a year. And what happened? Everything had to retract back to levels of affordability for locals. Once the foreign rich investors can't get in anymore, you're going to have a little wave of Hong Kong citizens moving into Australia. That's going to keep the bubble going for a little while longer. So the people waiting on the sidelines forever are going to have to wait longer if there's a huge migration of Hong Kong citizens. But skeptics warn about the mini bounce is just a blip, although they might agree there has been a positive growth in many areas in the country. They say values are being inflated again by easy credit, that the real economy is too weak and prices could still fall at least another 10 points. 10 points in Sydney and Melbourne is sweet, generous, but no, it's got to go down another 30 to 45 points of. You need to go to when the asset bubbles were propped up. So you got to go back to when they originally lowered rates. From that time, It's been an asset bubble. It's been a bubble, asset bubble, just feeding off speculation. So you got to go back to that time. That's the only way it's going to work. Look at London. They're what, 20, 30 months now declines? Whew. The point is, this week's desperately bad figures from the construction industry, which showed a total value of building work on homes in the June quarter, dropped seasonally adjusted 5.1%, or $699 million on the previous 3 months. Data about private capital expenditure was almost as bad. Taken together, the incredibly weak data, to use the UBS's phrase, has prompted economists to revise downwards their forecasts for economic growth for the second quarter due out on Wednesday. So this article, I think it's yesterday's, or is it yesterday? It's 2 days ago. House prices in the inner city areas of Sydney and Melbourne look a bit stronger because they're lower supply and more appetite from buyers. If you go granular, it's a different story, he says, pointing out to his research that he showed 30% plunge in unit prices in the outer Sydney suburb of Ryde in the past 12 months. So I've been predicting this for many years now, many years now. And let me see if I could find it here for you guys. I've been predicting this for many years, and see if I could get it here on the... So I was predicting I think it was a 40% drop. I can't really remember if it was 40% or what it was. So I did a documentary and kind of threw some stuff together. Here it is, guys. So this is my predictions, and these go way back. So I've been showing this on this channel many times. So Sydney, Vancouver housing crash 47% by 2016. So this is in 2015, because I already knew that pricing was over. From what the average Sydneyan or Sydney-sider or whatever you want to call them, what they make in respect to what the values of things were even in 2016 was just unheard of. That's why you had a mass movement of people moving to Hobart, right? And Canada, UK, Australia, New Zealand debt prison, same thing. I was talking about, what was this? November 11, 2015. There's no way. The amount of debt people are getting into, the reports we were getting, I was getting reports from, Equifax. The Equifax, or the, whatchamacallit, those guys that do credit inquiry, when you inquire for credit and you apply, and they check your credit score. I was checking all kinds of different websites to see what the credit seeking was in these countries, right? Supply versus demand is an illusion coming in 2016, because I kept picking on the empty homes that the Chinese investors were buying and leaving them all empty. So I kept picking on that, and I knew in 2016 you're going to see this, right? And then we move on to right here, Sydney, Vancouver, Auckland, London, massive housing correction this spring. I was wrong every single year. Why? Because I wasn't expecting the government to do what he was doing, the banks to give interest-only loans, all this Mickey Mousing, first-time home buyer loans, and then they try to fix it by putting stress testing. Now they're easing it again, and then it's just people are in a debt prison, and that's what it is. This is the documentary I've been working on, and I'm not going to do it anymore because it's been I've been working on that for a while and I never bothered with it. But okay, rising unemployment and stagnant wages are threatening the currents that could pull the market down. The prospect of the worldwide recession on top of that would make the situation even worse. Now you got all this crap happening in China, all these protests. In China, in Hong Kong. You're seeing trade wars with the United States. 5-6 years ago, we didn't have any of this crap, but we're having it now, right? It's all about stagflation and debt building. We no longer build wealth. Before, you used to save your money in a 4 or 5% high interest account. You would make money off your savings. You wouldn't have to bother to speculate in the risky stock markets. You wouldn't have to bother with that, but yeah. So, but in an argument that shows polarization of debate, some housing market analysts say the slowdown in construction merely removes the factor of holding prices back. Oversupply and the pipeline of building work dries up in the coming months. Prices are still inevitable rise. So we spoke to a few people here on the channel from Melbourne and Sydney, builders, and they telling me that they're having a huge trouble finding work, or they're not going on full time. What is not in doubt is that the property prices are very important to households across the country who might be thinking about buying or selling. Should they take the plunge or should they wait? Pete Wargant, a buyer agent in Sydney, had no doubt. He says the market outlook turned on a dime. After the 18th of May election, if you're ever going to buy, now is the time, because we're looking at a low interest rate environment for 5 to 10 years. They're going to lower rates for 5 to 10 years. It's going to devalue their dollar. This is yeah. So what if they have to raise the price, if they have to raise interest rates to kind of maybe prop their dollar up a bit if it starts dipping too fast? Figures from CoreLogic suggest that he might be right. The research company keeps a monthly scoreboard on the latest numbers, suggests prices in Sydney and Melbourne have risen 1.58% to 1.69% in the past quarter compared with previous 3 months. The aggregate for Australia's 5 largest cities in the rise of 0.68%. That follows a fall from the 27 peak of almost 15% in Sydney and more than 10% in Melbourne. Matthew Hassan, an economist at Westpac, says the bank's monthly survey showed Sydney's price correction has now clearly ended with a 1.3% rise in August. Lois Christopher, managing director of SQM Research, is also confident, and he thinks there could be double-digit growth in prices in the next 2 big cities in the next year. Well, we're going to hold you to this, buddy, and we're going to keep an eye on it, because last spring, guess what? Right here, last spring. That's what happened last spring. As credit becomes easier to obtain and more stock comes up for sale. Do you know what you guys are saying to yourselves? Credit is more easy to obtain? Hi, would you like to be a slave? Here's your handcuffs. You can put them on yourself. That's what you're saying. Here, I'll put my handcuff. Here, go, honey. Put this other handcuff for me. I can't reach. That's what you're doing. It's like you're indoctrinating yourself into slavery. Jeremy Rosen, director of Gary Pier and Melbourne Bayside Estate Agency, says the market feels more positive than it did 6 months ago. He attributes that to the outcome of the federal election and the subsequent policy resetting by APRA. It feels that there is more money out there, he says. More debt! Tap into your equity! Reverse mortgages! How many people right now are underwater? Who knows, man? Who knows? 6 months ago, we might have had 1 or 2 bidders, but now we have a multiple bidders at or above the vendor's expectations. He also says investors have returned to the market, having all but disappeared a year ago, and the outlook looks positive. So, I can't believe they're lowering rates in hindsight of what the Royal Commission found when they were sniffing around these banks and the amount of crap they found. I can't believe they're lowering rates. Credit could be even more cheaper when RBA holds its monthly meeting on Tuesday. Many economists think that's tomorrow. It could cut the cash rate from its current 1% at least twice in the next 6 months, taking mortgage rates to uncharted territory below 3%. Oh my God, why are they doing this? This is economic suicide right here. Research by RateCity shows 6 lenders already have variable rates within a 2 in front of the numbers expect to climb to a 20 points after the next RBA cut if banks pass on at least 0.2 to borrowers. Buddy is concerned that policymakers appear intent on propping up the economy but encouraging more people to borrow money and buy houses. See, that's what Australia's economy is based off. It's backed off of housing, right? So is Canada. Canada's not free and clear of this. With Australia households already the second most indebted in the world at 120% GDP. So this ties into this video I made. If you're in Australia, you got to watch this video, negative rates. I want to make it. And I made so a list. I'm going to get onto the list here. This is what I have. This is what rates need to sit at respectively due to the income ratio that people are making and due to what the averages are, okay? All right. I looked at what the average wages are, not minimum wages. So people on minimum wage, this ain't for you. This is more for... Anyways, let me get to my point. Number 1, United States of America is at number 1, but it's at the top of the list in a good way. And Interest rates in the United States of America need to sit at 1.5%. Looking at its economic charts and looking at its GDP and its earnings and stuff, United's exports and stuff. Right now, I know trade wars. Right now, United States of America, if they could keep rates at plus 1.5%, they could. I think they could phase through this somehow. Watch this video and you guys will see where Australia is at, in my opinion. Hey, what do I know? Nada. All right, let's go back here. The problem is that debt is greater than income, and in the end, you can't fight the maths, Clausen said. You can't fight off the debt if your income is not growing, so you get more into debt. So remember how wages haven't moved in the last 40 years? There's a lot of huge human labors up here, and wages are here. So there's this huge delta right here that we're kind of facing right now. See, I'm facing it right now, see? And that's why I've always worked for myself, because I kind of figured you couldn't do it even if you're, unless you're a really like high paid plastic surgeon or something, or you got something like that, right? Or a really good lucrative business that a corporation hasn't sued you or shut you down over or something, then I see you doing well. But the Reserve Bank has been forced into cutting rates because the government is chasing a surplus. Thank you! Thank you! So we have reached a plateau for a short term. We've already broken the glass in case of emergency. The housing market is vulnerable. It's fragile. So if we get an external shock, such as an upheaval in Hong Kong or from Brexit, there is nothing to stop the falling quite significantly. So I got to talk to, who's this guy? This is Daniel Clausen. Yeah, man, I gotta talk. Message me, dude, if you're watching this. I don't think you are, but if Daniel Clausen, if you are in the house, please message me. I would like to add me on Skype, and maybe we could do a discussion. My Skype is Mike Martins 1980. Don't forget to join me, guys. Wednesday nights my time, which would be Thursday in Australia and New Zealand, and really early Thursday morning in the UK, and Wednesday at 7 p.m. Western Seaboard time for Trends in the Housing Market. The longest trends show right here. You want to watch that show with rates, eh? First one right here. Trends. So second one down on my channel. Trends in the housing market. We get callers from all over. All right, guys. Bring our mortgage rates even to negative territory. Yeah, I don't have too much time, and I don't want to steal other people's content either. Like, I try to stay as original as I could.
Are they stealing from you, like the big guy?
So yeah, people stealing my content. Yeah, people are messaging me saying, Mike, the video you put out yesterday, someone just copied it and put it out today, like the next day after you. It's like, I know, it's like the big guys are this is a small channel, guys, and don't forget to check it out. I also have a Patreon account if you guys want to support that. Here it is. I got 14 subscribers on Patreon. If you want to donate $1 a month for coffee, $1 a month buys my coffee. And I am at, right now, again, 14 Patreons. So if you want to sign up and support the transmission, please do so. Thanks for watching, guys. Let me know what you guys think in the comments below. And yeah, I look forward to reading your comments. I read every comment, by the way, guys. Anything in the last 3 weeks, I still read today and get notifications for. Thank you so much.